So, if you ever heard of the concept become your own bank or infinite banking, these are actually concepts, they are not products. However, though, a lot of people use this product specifically like life insurance to consummate the plan known as infinite banking. So, let me explain something very clearly. A lot of agents are running around, they talk about infinite banking, be your own bank, but they are using regular type of life insurance policy to consummate the plan. It's a mistake. Why? Because year one, year two, year three, you have a zero, zero, zero in cash value. So what happened therefore is this, you really can't go into your account and take money out, but you've been paying for the last 2 or 3 years. That's a falsity. To avoid that, there's a specific type of a policy that we have to put in place in order for you to experience that. And so we'll do something we call max funding, minimum debt benefit. So what it does is it allows your cash value to grow day one for some, year one. So the money is there for you when you need it. So let's get into it. As you guys know, this month is considered the Life Insurance Awareness Month. And I want to be able to explain to you today how to use life insurance to reduce or even to pay off your debts. So again, it's paying off your debts using the instrument of life insurance. As you guys can see, you say right here you have your life insurance policy. But let me explain something very clearly. This is not the type of policy that you can just go from your cousin, your brother, your sister, your relative. Not at all. It's a very unique type of a policy that actually works the way it's supposed to work for you. Okay? So in a policy like this, you fund the policy, but it will start building cash for you year one. Because a regular policy takes about 2 to 3 or even 4 years before you build any cash. Typically, they're all is 0, 0, 0, 0, but you've been paying. So what we'll do is this. I will lose my commission for you. In other words, I will make sure that we do something we call max funding, a lower face amount with what? An opportunity for you to grow your cash tremendously. It's a different type. So as you grow your money, you can turn around. Say, for example, you take $10,000, okay, away. You take 10,000, from your account. So you borrow that money from your policy. And like in this case, let's say you have a 4 to 5% interest rate. Then the money, of course, is direct deposit into your account. It could be a day or two. You take that money and immediately what do? You start paying off your debt balances. For example, you get a credit card and maybe your credit card is like 18%, 20%. Maybe you have a $5,000 from there. Guess what you do? You immediately turn around and bingo, there you go. It's beautiful, guys. You pay off your credit cards. Let's say, for example, your credit card is $5,000. Okay, let's assume that $5,000. So that's this credit card right here. You pay the $5,000 off. So which means your credit card now becomes what? 0. So your 22% interest to 29% is also automatically wiped off. This gives you a great opportunity now to do money, to do things with your money. For even like cars, for example, going to 18 to like 20%, interest rate on financing. That's ridiculous, right? You could pay off your car, for example. That will free up percentage-wise. Could you imagine? By the way, that kind of money you could actually buy stocks, you could go into real estate investments, whatever the case you want to be, or just keep on paying off your debt. You have choices. But now let's assume you decided, okay, you know what? I'm saving the money now. So the money you were paying before to pay off your credit cards, maybe you were paying about, say, $300 a month just to pay off your credit cards. Guess what you could do? You could redirect this $300 a month, redirect it directly into what we call a redirection of monthly payment. So now all of a sudden that money goes right into your bank, and then this $300 moved immediately from your bank. I guess what you do? You move this $300 and then you move it right back into your life insurance policy. Now, you're getting credited 5 to 7% interest. That's how much you're getting credited. So you know what's powerful about this? You have something we call uninterrupted compound interest. Uninterrupted compound interest, okay? This concept right here is so amazing because this uninterrupted compound interest automatically your account is getting credited 5 to 7%. Pause with me for a second here. Your loan rate is 4 to 5%. So what's the difference between the two? No matter what, you're still getting a net positive of what? A net positive of 2%, no matter what. But let me tell you what's even more shocking. When they credit your account, they will credit your account as if your full balance was still in there. This is the most craziest part of this. What I just explained to you guys right now is how to use life insurance to pay off your debt. This is an incredible concept. Rich people are familiar with this. The Rockefeller knows this. The wealthy people know this. It's time that you begin to understand how to use life insurance for your wealth. So if you like any of this concept I just covered with you guys, either servicing your debts, paying it off, or even you're a small business owner and you're going to use this for life insurance retirement plan known as a LURP, whichever way, just DM me at 954-478-4498. Again, 954-478-4498. I have a whole team that is here to take care of you and to serve you.